Without further ado, let's start the webinar. For this session, we have Jonathan Wu, Glenn Thum, Amber Shah, Zain Aw, and Maximilian Koswoyo to present on the US Big Tech. Without further ado, let's welcome them. Take it away.
Thanks, Rashad. And good evening, everyone. Give me a sec while I share my screen real quick. Okay. Okay, so thanks for joining us. Today we'll be sharing, we'll be going through, our third quarter 2023 tech strategy and stock picks. So we will be running through, myself and the rest of the US research team will be running through a little bit on, the performance of the last quarter, the second quarter of this year, some macro themes, sector themes. We'll go through some of our stock picks as well as a couple of technical analysis in our technical pulse section. And we'll be follow up with a conclusion and then a Q&A as always. So just in case you have any questions, feel free to post them in the Q&A tab below. And we'll get to it after everything is done. So before we begin, or rather, let's just begin. Let's take a look at how the US markets actually performed in the second quarter of this year. If you can see, the Nasdaq was the best performer. It was up about almost 40% for the first half of 2023, and up 15% in the second quarter of this year. When you look at just the US market overall, the US market for the first half was up 16%, while it was up about 8% in the second quarter. Something worth noting is that we think that a large reason for the outperformance in the Nasdaq is mainly due to PE expansion, and as well as a little bit of a soft landing scenario which everyone is expecting, as well as some margins bottoming out in terms of bottom line margins for a lot of big tech companies. When we take a look at the FANG-M, which is your bigger 5 tech companies. So right now they're targeting the Magnificent Seven, but we'll still keep it at FANG-M for now. The FANG-M was up almost 50% for the first half of 2023 and up almost 20% for the second quarter. Significantly, in terms of the Nasdaq, when it's up like 40%, it's about 4 times more than its 10-year average for one half in a particular year. So its 10-year average for the first half in any year in the last 10 years is about 10%, or rather like 8%. So it is quite unusual for the Nasdaq to have such a strong performance. And one of the main reasons, obviously, it's doing well is because of big tech is doing well. If you strip out big tech from the Nasdaq and the S&P 500, the S&P is up maybe about 4 or 5% for the year, and the Nasdaq up around maybe 8 or 9%. So quite significant contribution from big tech guys. When you look at the individual sectors, your tech and growth stocks continue to lead the way. So your semiconductors, your tech, consumer discretionary, as well as communications, which are essentially companies like Google, Netflix, and Disney. While all of the defensive continued to lag, so sectors like staples and utilities, as well as interest rate sensitive industries like real estate. So we'll move into the macro themes for this past quarter and what we think we could see moving forward. We still see inflation remaining fairly sticky. CPI numbers came out last night and it showed some decline, but when you look at it objectively, inflation is still quite high. It's more than double the Fed's target of 2%. When you look at the core PCE, and we think a big reason for this is services that it is seeing some decline, but it's still fairly sticky, mainly due to a tight labor market, as well as hourly wages that continue to increase. When you look at goods, inflation, the goods is actually in a deflationary environment right now. So we don't, a lot of the supply chain issues have kind of normalized, and we're not really seeing a lot of resistance there in terms of bringing overall inflation down. It's really more focused on services that is kind of holding everything up. Yeah, and we do think unless unemployment really starts to rise, it'd be very difficult for services inflation to come down because everyone's employed, their wages are still increasing at a fairly decent rate. They've got spending power, and and it's just going to be if unemployment doesn't really rise, it's going to be difficult for services to kind of come down. So unemployment numbers, job opening numbers, non-farm payrolls will be very interesting to keep an eye out for. The second macro theme we are looking at right now is the Fed. Is nearing the end of its hikes, and it's quite evident because of the last couple of meetings where they specifically mentioned how many times you're going to raise, essentially 2 more times till the end of the year. And what we're seeing right now is that the Fed funds rate is actually sitting, above core inflation, and it's been there for the last couple of months. Usually, what happens is once it gets above your core PCE, you start to see inflation trending down a little bit more than obviously if it wasn't as high as what it is right now. So the Fed funds rate right now is about 5.1%, while core PCE is about 4.6%. Although I do expect that by the end of this month, when the PCE reading comes out, it'll probably be a little bit lower, maybe 4.4, 4.3%. So what the market's actually pricing in is actually only one rate hike for the rest of this year, and 5 cuts for 2024. And so they're expecting 25 basis point hike in the next this upcoming July meeting, before I guess pausing most of the way until cuts start to come in early next year. Although the Fed has actually mentioned that they're going to be raising it another 2 times and another 50 basis points. I guess the market's kind of not really believing what the Fed's going to say because they are encouraged by declines in inflation, and they think that the Fed really isn't going to raise it as much as it would. But we do think that it's quite unlikely that the Fed's going to only raise it once. I think they're going to be sticking to their guns. They're going to make sure that the inflation really does come down. And instead of doing, instead of making the mistakes in the past where maybe they weren't as hawkish as they could have been, and they eased it a little bit too soon. So yeah, this is just essentially what the market is pricing in right now. So if any case, even if the Fed does hike a second time, we don't think it'll be that detrimental to expectations because they're fairly close already. The third theme that we're seeing is economic indicators still remain fairly weak. This chart is just your yield curve, the 10-year minus the 2-year spread. The bond market is still pricing in a recession. I guess a lot of economists actually expect it to come in the first half of next year, instead of it being in the second half of this year. And we do what we've learned from the past is that we do see recession tend to occur once the yield curve reinverts above 0. So right now, it's about -1. And so we're actually really far away from 0. And this has been the largest inversion in, I guess, the last 40, 50 years. So it's a little bit concerning that the bond market is flashing some red signs. It's not a guaranteed 100% recession call, but it has worked out fairly often when it comes to the yield curve inverting. When we look at some of the manufacturing or some of the PMI numbers, manufacturing PMI is contracting a little bit. Right now the reading's at 46, and generally anything below 50 is a contraction. So manufacturing is a little bit weak. Demand still remains, demand for goods and stuff like that is still a little bit weak for the US economy. However, when you look at services, it still remains above 50. It's at 54 right now, and a big part of it is like I mentioned earlier, wages and basically full employment. So what we usually learn is actually when the Fed starts to pivot, when it starts to cut rates, it's usually done because there is a recession coming, and the Fed's actually, I guess, a little bit worried about the economy. So you look at the last couple of recessions since the 2000 dot-com bubble. Once the Fed actually start cutting its rates fairly aggressively, the equity markets just really tumbled along with it, which is a little bit counterintuitive, because you would think that when rates are a little bit lower, it's it's lower cost to borrow money, and the equity markets should be thriving, but this hasn't really been the case in the last 20-30 years. The fourth macro theme that we're seeing is earnings still continue. There's still headwinds in terms of earnings, and we do expect this to persist moving forward. You look at this, it's the forward EPS growth chart for the S&P 500. And you look at the three red circles, in the last few times, earnings has gone below zero and gone into negative growth territory. Equity markets have fallen alongside with them. But what we're seeing right now is quite interesting, because we're seeing a very large divergence. You can see from June 2021 until now, forward EPS growth has actually been declining quite significantly. I guess from its peak at about 50%, right now is around about -5 or 4 or 5%. But the equity market is still rallying. So it's something that we think is very unusual, judging from historical data. And we do actually expect some sort of pullback in equity market, as long as earnings kind of continue to contract. When we just look at some valuations for the Nasdaq, the Nasdaq has actually gotten way more expensive over the last 6 months. It's gone from like a 25 forward P or 23 forward P, so slightly above its long-term average, to right now is almost close to 30, which is almost two standard deviations away from its 15-year average. Obviously, a large reason for this is the hype in AI, and the re-rating of a lot of companies. And it's something that we think, in terms of the AI hype, is a little bit overblown. I mean, we understand the long-term implications of AI, but we just don't think that AI can give such a strong boost in terms of earnings in such a short period of like 1-2 years. A lot of people are saying it's like an iPhone moment, but the way we look at AI is a little bit more like an upgrade. So, for example, you're upgrading from like iPhone 8, 9, 10, 11 instead of going from a BlackBerry to an iPhone. We think that is probably what AI is how AI is going to impact the market instead. So that's all for macro trends. We'll move into the sector trends, and to begin this, I'll hand it over to Glenn, who will talk a little bit on the banks. I know the banks aren't in the tech sector, but because we had a lot of questions on it the last time we did this presentation, so we figured we get Glenn to come and help us with the banks. So with that, I'll hand it over to Glenn.
Thanks, John.
Yeah.
So I think a lot of questions regarding specifically the US banking sector, especially with what happened with the SVB and Signature Bank. So we'll just be doing a short summary on the banking sector, the US banking sector at least. So our title is The Banks Under Pressure. So this is just a very quick sort of recap of what happened during the first quarter, at least for the 4 largest banks in the US, namely JP Morgan, Bank of America, Citigroup, as well as Wells Fargo. So we just look at the 3 boxes here. The first box being the net interest income, which is the sort of the talk of the town now. Net interest income has been growing relatively well, with 2 banks recording above 40% and the other 2 banks above 20% year-on-year increase. And this has mainly due to the current high interest rate environment, and which goes down to higher net interest margins. However, if you look at their non-interest income, it seems to be pretty stagnant, and this is mainly due to this continued decline in their investment banking arm. And I think this is sort of mainly due to market sentiment, and it's shared among all four banks. One more thing I'd like to highlight would be that the provisions have started to normalize, and we could even possibly see this increasing going into the rest of 2023. So just for a quick outlook on at least the banks moving into the rest of the year, I would say net interest income should continue to show this record growth, and we should definitely expect at least a double-digit increase for the next few quarters, as the high interest rate environment is still beneficial to the banks. As for the investment banking side, I would think that this wouldn't be sort of improving anytime soon, and we could still see this sort of slide downwards. As for provisions change, I think it's hard to say, but there's a possibility that provisions might even inch up higher than pre-pandemic or during the pandemic times. As nowadays with the high interest rate environment, the borrowers are feeling the pinch, and especially with fears of recession. Okay, now moving on to my next slide. Yeah, so this is just showing a quick graph on the US banks' commercial loans growth. So we have plotted it all the way back to 2003, and you can see that the last two times at least, it was negative. It was in the 08 crisis, 08-09 crisis, as well as the pandemic, actually no, post-pandemic. During the pandemic, it spiked up as the interest rates were really low. So we are currently seeing a sort of a downturn, and I think the banks will continue to feel that the loans growth might continue to decline going into the rest of 2023, as the Fed, as John said earlier, doesn't intend to lower rates anytime soon, and the consumers are starting to feel the pinch with higher interest rates loans, and they might not be able to take up loans as easily as it was during the low interest rate environment. Okay, now moving on to the next slide. Yeah, so this slide graph shows the Fed's loans to the US commercial banks. And why is this important, and why did I put it in? I would say that the Feds don't really loan to the banks. It's only in times of crisis. If you can see that it's mostly flat throughout the years when everything is going well. However, 08-09 again, you can see that there's a very big spike up. And recently, the last at least 2-3 years during the pandemic, it also went up, but it wasn't as high as it was now. And this is mainly due to the collapse of the two banks, of the Silicon Valley and Signature Bank, and this caused panic among the consumers, which led to a bank run, and mainly the smaller banks had to borrow from the Feds. And I would say the Feds also came up with this new lending program, which also sort of caused this spike up in the loans to the US commercial banks. Is this a good thing or a bad thing? I would say it's both. It's a bad thing. Some people might look at it as a bad thing and say that, oh, this is, it's sort of an indication that the banks aren't doing well and that they have to borrow from the Fed. However, on the flip side, if you look at it, it is a positive thing, as the Feds are stepping in to help the banks. So in the case of SVB, they ensured that the depositors were all covered. And the banks are not afraid to sort of leave it to what SVB did until they collapsed. So now the banks are, sort of preemptively saying that we need to borrow from the Fed, so to ensure that our customers are well covered. Yeah, so that's all I have for the banking sector. I'd now like to hand it over to John. Thanks.
Thanks, Glenn. Okay, so the next, I guess, trend we'll be talking about is EVs. EVs have been fairly popular over the last couple of quarters. Both in equity markets as well as just consumerism, right? You're seeing a lot more EVs on the road nowadays. So hence the title, EV push is actually heating up. So we have two charts here. The first chart on the left is global sales for EVs. So global sales for EVs in 2022 were about 7.3 million units, which was up about 60% year on year. So very significant growth from 21 to 22. And EV sales has actually been growing at almost a 60% CAGR over the last 5 years. So we're seeing, this is still, we're still kind of in the infancy phase of adoption for EVs. And we do expect EV sales to hit almost 30 million units globally by 2026. So that puts it at around a 40% CAGR. And obviously there are several reasons for this. There's the main, I guess, the main push, is the whole electrification, I guess, topic, right? Where a lot of governments are giving incentives to companies to go green, to become zero emissions and all that. And we think that with these kind of tailwinds, it's very difficult to go against, and it's definitely a very positive thing for the whole EV industry. When we look at EV sales as a percentage of total vehicle sales, because at the end of the day, EVs would just be they're going to be fighting in for market share with other ICE vehicles, internal combustion vehicles. So right now, or rather in 2022, EVs, and when I say EVs here, I'm also including plug-in hybrid vehicles. And so in 2022, EVs were about 11% of total vehicle sales. As of right now, it's about 15%, I believe. So even in the first half of this year, we've seen quite a significant jump. And we do expect that by 2026, about 1/3 of all car sales would be EVs. And this is quite a significant thing because I guess a few years ago, it'd be very difficult for you to find a solid EV car on the road. And there are three reasons why we think that we should be bullish for EVs right now. Firstly, the demand far outstrips supply. So a lot of the manufacturers like Tesla and BYD, they don't have enough capacity to fulfill the demand or the orders that are coming in. So because they have this backlog, they can just keep producing and keep selling their cars. And secondly, unlike traditional ICE vehicles, EV companies right now are actually investing quite heavily into increasing their production capacity to meet the demand. And lastly, due to improving technology, cost for batteries and components have come down quite a lot, which increases the performance of the EV cars. It lowers the cost of the cars, increases their range and their power, so they're a little bit more compatible to ICE vehicles. When we look at market share right now, BYD actually has the largest market share in EV. Just a caveat, half their cars are actually plug-in hybrids. So they're not a pure EV play like Tesla is. Tesla is second with about 20%. The Volkswagen Group, Audi and Porsche and all that, they are third with 10%. And BMW has about 5% market share. We do expect this order to remain fairly constant because they're the most well-established EV players. So they've got more mature production and supply chain lines. And the chart shows that their market share is going to be decreasing, and one reason for this is because there are more and more EV players coming into the market. So just naturally, their total share would kind of decrease as the years go on. In terms of percentage of total vehicle market, Tesla right now is about 2% of total vehicle market, and BYD is only about 3%. So there are significant room to grow for Tesla and BYD. As much as they're conquering the overall the total auto vehicle market. Just in the first half alone, BYD delivered 1.3 million cars, which is basically double what they did in the first half of last year. Tesla delivered almost 900,000 vehicles, and that's about 60% year-on-year increase. Funnily enough, the most popular car in the first quarter of this year was actually the Tesla Model Y. So it beat out all the other car brands and models. The next four on the list were all Toyota cars, so the Toyota Corolla and Camry and the other two models. So you can already see EVs are really starting to ramp up over here. So with that, I'll hand it over to Max to carry on with the semicon industry. Thank you.
Yeah, thanks, Jonathan, and good evening, everyone. So I'll just a brief update on what is going on in the semiconductor industry. And as we can see from the title, we think that the market seems to have bottomed out. Next slide. Yeah, so this is a chart of the year-on-year growth for the global semiconductor sales. And as we can see for the trailing 3 months ended in May, sales is still down as it experienced a negative growth of 21% year-on-year. But on the bright side is that the sales has been down for negative 21 since the month of March. So it means that the market seems to have bottomed out, whereby the decline is not getting any stronger. It's not getting stronger. So this is pretty much in line with what the major players have guided during the earnings call in the past quarter. And this brings about hope that the market can expect a gradual recovery to start in the second half of 2023. Next slide, please. Yeah, so if we zoom in on the different types of chips, we will mainly take a look at CPU, GPU, and memory. So for these numbers, we use the sales numbers from the companies that produce these components as a proxy. So for example, for CPU, we take the numbers from Intel and AMD. For GPU, we take it from NVIDIA. As for memory, we take it from Micron, Samsung, and SK Hynix. So yeah, as we can see from the chart here, on the orange line, which represents GPU, GPU is the leader in terms of the recovery trajectory. And I guess this is no surprise because firstly, NVIDIA has already provided such a strong guidance for the second quarter earnings. And then secondly, it's also the fact that GPU is the main component enabling generative AI technology, which is the trend at the moment. So yeah, and GPU market is already expected to have a positive growth in the second half of this year, whereas CPU and memory is still lagging, where they both declined by 21 and 40% respectively. So this is the number of trailing 12-month sales. So it kind of lags as to what we are seeing in the market currently. However, the theory is the same, whereby the market seems to have bottomed out even for memory. So right now, as you can see towards the end of the blue and the red line, the line is roughly flat over the past 2 quarters, which means that the sales for the past 12 months have already flattened out as well. And this supports the charts that we showed previously that the market has bottomed out. So, and then we would like to know that although it is not here on the slide itself, when we look at the quarterly numbers, we have actually seen that the market is pricing in that there's an expected recovery in the semiconductor industry for these companies as well for the second half of this year. So yes, it will still be a negative growth, but it will not be as significant as the negative 21 or 40% that we see here. So if I remember correctly, for the CPU market, the market is expecting a negative 9% decline for the third quarter, which is quite a significant improvement. Whereas for the memory, we think that it's going to decline by about 20%, which is also quite a significant improvement as well. So yeah, overall, just to reiterate, we think that the semiconductor market is already bottomed out, and this is in line with what companies have guided over the past quarter. And there's a hope that, and actually there's a early signs that the market can expect early recovery at the second half of 2023. So yeah, with that, I'll hand over to Ambrish to talk about the cloud market. Thanks.
Thank you, Max, and good evening, everyone. So moving on to the next sector, cloud. Next slide, please. So we believe that AI should accelerate the cloud computing demand. So basically, cloud computing, it means that you store a particular data over the cloud, and you don't need to store that particular data on your local computer, and you can access it from anywhere over the internet. So and it's just like you rent a space from cloud providers, and the 3 main cloud providers globally are Amazon's AWS, Microsoft's Azure, and Google Cloud. So just as an example, Netflix, it heavily relies on Amazon's AWS for its cloud needs. And basically it stores its movies and series and content basically over the Amazon server. So it does not spend on its own infrastructure, and as a result, it saves a lot of money, and it has a global reach as well. And also it helps in improving collaboration. So moving on to the public cloud market share, we believe that it's likely to be expected to grow by about 20% over the next 3 years, and it should reach about 700 billion by 2025. And the main growth drivers for this would be the digital transformation trends, as the companies that digitize their operations in order to be competitive. And we also believe that AI should also drive this demand, mainly because, let's say, for example, if a company it wants to integrate generative AI into its business, into its existing products and services. So in order for that, it has to rely on a cloud computing need, mainly to run the AI algorithms, as well as to analyze huge amount of data. So this should benefit the cloud providers like AWS, Azure, and Google Cloud. So that's all for cloud. I would now like to pass on to Jonathan for our individual stock picks.
Thanks, Ambrish. Okay, so I'll begin with Alphabet. So we'll just run through some of the companies that we have coverage over, just to give you some of our thoughts and some of our recommendations. So for Alphabet or Google, we titled the slide, AI to drive margin recovery. And that's important, but the main thing for Alphabet is that at the end of the day, it is an advertising business, and most of its revenue comes from ad revenue, specifically from search ads. So whenever you go to a web browser to Google for something, that's its main driver for growth. And what we're seeing right now is we're seeing some resilience in search. So if you look at this chart, your ad revenue growth has been declining ever since the highs in 2021. And what we're actually seeing is some sort of bottoming out in terms of search year-on-year growth. And we do think that this is a very promising sign as the company, as I guess not just the company, but the digital advertising industry recovers as a whole. Secondly, we think that the company's focus on cost structure optimization, which essentially is another word of cutting costs, is something that I guess is a bit more sustainable. The company has cut about 6% of their workforce, as well as they've consolidated a lot of office facilities, reducing it in smaller capex. So we actually cut our capex forecast for Alphabet for this year by about 17%. Because of this, so we think that this kind of optimization will definitely help their bottom line moving forward. And the third thing, we think that AI will continue to drive efficiency within the company. So we expect AI as well as automation to drive a lot of workplace productivity for the company. And lastly, cloud profitability. So cloud was profitable for the first time in the first quarter of this year. It's something they mentioned that they were quite happy about. And because cloud margins are relatively large, we do think that as their cloud business grows, as their margin grows, it will just be incremental benefit to overall margins for the company, and that's something that we're quite excited about as well. So we have a buy rating on Alphabet with a target price of $131. So moving on to my next company, Meta Platforms. We titled it Still Below Pre-Pandemic. And over here, the chart is just their net margins, over the last several years, and what we expect net margins to be in the upcoming years. So the first thing is that we do expect margins to recover quite significantly, or at least to continue after significant cost-cutting measures that they have done over the last 9 months. So they've reduced their workforce by about 30%, which is quite significant. I mean, essentially, if you're looking at your colleagues, 1 in every 3 is gone. It should actually help, margins that deteriorated severely in 2022. What we're still a little bit concerned about is that it's still, way below the pre-pandemic margins of about 30+%. Even after our forecast, and one of the reasons dragging this down is obviously their spending on platform changes. So in the last year or so, they've been transitioning from feed and static kind of more static format into Reels, which is a more short form format. And this kind of places a short-term drag on margins due to its lower monetization levels. Because if you think about it, for Reels, there's really a lot less opportunity for advertising placement. So if you scroll through your Instagram reels, right, you really rarely ever see advertisements. Whereas if you're just scrolling through the feed or even Facebook feed and all that, you really get ads quite in your face. And so as more and more people start viewing short form video like reels, it kind of pulls away, it kind of cannibalizes the static advertising business. But we do think that this is going to be more of a short-term headwind. But in reality, in the long term, it should be a tailwind because Reels is getting more and more popular. You know, as more and more people shift to it, there'll come a point where it tips the equilibrium in terms of monetization. Lastly, you know, there are still some short-term digital advertising headwinds that we are seeing. Unlike Alphabet, which is really a pure play digital advertising. I mean, they are monopolies in so many industries. Meta is a little bit, you know, they're not in as strong a position because of they're essentially just a platform, and they don't really control as much of the market as Alphabet is. We actually have a neutral rating on Meta with a target price of $235. Mainly because the stock price has really shot up. It's gone up like 200+% since the bottom towards the end of last year. We do think that it is a little bit overblown, and that's why we have a neutral rating on it. So moving into my last counter, Netflix. So we expect margin expansion from Netflix to be fairly gradual. Recently, they have introduced a couple of I guess new initiatives. The first initiative would be an ad-supported plan that is basically half the price of a standard plan. So what this comes with is obviously ads in your streaming experience, hence the lower price point. And they also are cracking down on password sharing amongst a lot of the users because the company estimates that about half their subscribers actually share passwords outside of a single household, which is I guess, you know, not really allowed. So you would have, and this has extended to Singapore as well. So if you're in Singapore and you use Netflix, you would have had an email or when you log into your Netflix account sometime in the last couple of months, they would have prompted you to do some actions to make sure that the device that you're watching on is actually your I guess your household device. There are some positives from the ad-supported plan, which is good news for Netflix, and that's kind of why the stock price has run quite significantly. The earnings comes out next week, so once it comes out, maybe we'll get a little bit more clarity on that. Our second point is that we still do expect the streaming market to continue to provide tailwinds. You know, streaming as a whole compared to just the US TV market is gaining a lot of market share. Obviously, the main reasons are firstly, it's cheaper. Secondly, you can watch it on the go. And thirdly, there are better shows to watch on there and better ways of keeping entertained. One of the downsides for Netflix is that a majority of membership growth is actually coming from APAC. And APAC, you know, it doesn't monetize as well as the US. So in the US, I believe that the prices are, their standard plans are like $14 or $15. So it's like 20 Singapore dollars, and over here it's like $15 for a standard plan or something like that. So you see that the buffer of about 20-30% in ARPU, and that's just in Singapore. It's a lot cheaper to get Netflix in a lot of developing countries in Southeast Asia as compared to Europe or the US. And so as membership growth kind of increases in APAC, it kind of drives down ARPU, which is average revenue per user. We do maintain a neutral rating on Netflix with a target price of $388 US. And one of the main reasons why we have a neutral is because like Meta, the stock price has really run up quite significantly over the last 6 to 9 months. So with that, I'll hand it over to Max to carry on with his counters, Apple, Amazon, and the semiconductors. Over to you, Max.
Thanks, Jonathan. So I'll continue with Apple. Yeah, so for the first one for Apple is that we believe the growing services revenue contribution is going to boost the company's overall margins. And this is because services revenue is of high margin. It has a much higher margin at 70% compared to the 30% from its product sales. And it's also recurring in nature because most of these revenues are coming from subscription-based. So the services revenue has made up about 20% of the company's total sales in the first half of this year, compared to 18% of the first half of 2022. So we think that this segment is going to keep increasing its revenue. Is going to keep increasing its presence and sales contribution. So because of this, we think it's good. Apple is able to expand their margins further moving forward. And then for the second point is that we are not expecting any material financial impact from the launch of Vision Pro. So just as a background, Vision Pro is a virtual reality headset that allows the users to have virtual reality experience whereby the content is projected. It seems like the content is projected onto your surroundings. So Apple has said that the Vision Pro will be available in the early 2024. And it will be priced at $3,500. So the reason we think that the Vision Pro will not contribute a significant amount of sales is because we believe there will only be a limited number of customers who are willing to buy this device given the high price tag. So instead of being a revenue growth driver, we believe that the launch is intended to establish a stronger supply chain as well as a pool of developers so that they can enhance the user experience for the device for the subsequent generations. And so yeah, that's for Vision Pro. And then lastly for Apple is that we're expecting a negative growth for the rest of the financial year. And this is because we believe customers are more than likely to defer their iPhone purchase, especially when September is only about 2 months away. And we think that they are going to wait until Apple launches the highly anticipated iPhone 15 in September. So because of this, there's going to be a negative revenue growth. But on the flip side is that we believe this will create a pent-up demand, and therefore we think there is going to be a revenue growth reacceleration in FY24. So overall, we maintain our neutral rating on Apple at a target price of $183, mainly because we see there's a limited near-term upside for the company. Next slide, please. Yeah, so moving on to Amazon, firstly is that we believe its AWS is going to benefit from the current generative AI trend. And just as a side note, it's not only specifically to AWS, it's more of a generative AI is going to benefit the other cloud service providers as well. So, however, in terms of AWS specifically, they have just recently announced 2 new AI tools, namely Bedrock and CodeWhisperer. So just for information, Bedrock is a service that allows the customers to access the foundational models of pre-trained AI models provided by their partner AI startups such as Stability AI and Anthropic. So what this means is that the customers can use these pre-trained models and then develop it further and then customize it further based on what they need, which means that the customers don't need to spend a lot of time and money to develop the models from scratch. And then the second product is called CodeWhisperer. So what CodeWhisperer is a coding assistant, whereby developers can just, let's say, when the developer wants to develop a platform, let's say they just need to type in, I want to build a video sharing platform, and then CodeWhisperer will just automatically generate the codes by themselves. So this saves a lot of time for the developer, and therefore it will increase the efficiency overall. So, and then I would like to point out that AWS currently has the largest market share of more than 30%. So we believe that, and all of the customers has mostly put all their data inside AWS. So we think that if the customers want to, the customers are going to face a high switching cost if they decide to shift to another cloud service providers, which means that more often than not, these customers are just going to continue commit to AWS, and then they're just going to opt for the newly launched AI tools. So yeah, moving on to the second point is that we see that the efficiency of the company keeps on improving. As you can see from the chart, the average revenue per employee has jumped by about 20% year-on-year in the first quarter, And we think this has the potential to expand even further, especially after the layoff takes its full effect. And then furthermore, recently, Amazon has also overhauled its logistics network, whereby it now operates as in an 8 regionalized model instead of one huge entity across the country, at least in the US. So what this means is, with the recent overhaul in the delivery network, is that Amazon is attempting to minimize the distance traveled by its products. So instead of shipping the products to the customers, no matter how far apart they are, they're going to prioritize the product. They're going to prioritize selling the products that are already within the same region as the buyer. So this will cut the delivery cost because long distance delivery costs more. And therefore, we think both of these factors combined, they are going to improve the company's margins overall. And then, however, for the third point for Amazon is that we think there's going to be limited headroom for growth for this year, mainly because inflation is still high, although they are coming down. Inflation is still high, meaning that consumers are still wary about their spending. So that's going to pose a certain amount of limitation in terms of how much the retail segment can grow. And then for the secondly is that the AWS customers are also optimizing their spending, and we are not sure when this is going to end. So we are not expecting any significant surprise in terms of the revenue growth for AWS as well. However, we would like to know that there's a chance that the AWS revenue growth might have a slight acceleration in the fourth quarter as Amazon roll out their AI offerings. So yeah, overall, we also maintain neutral on Amazon at a target price of $120. Then moving on to my next counter, which is NVIDIA. So for NVIDIA, the main story is that we are expecting a very strong second half. And this is because NVIDIA has already guided for 60% year-on-year revenue growth for the second quarter. And they have also indicated that the second half of this year is going to be stronger than the first half. So we think this is substantiated, especially as I mentioned just now, GPU is the main component for the generative AI technology, and NVIDIA can be seen as the sole supplier of the GPUs to cloud service providers as well as enterprises. So and then that brings me to my second point is that we think the company is going to experience a margin expansion as well because it's interested to benefit from higher average selling price. So majority of the revenue growth will be driven by its data center business, and this coincides with the launch of its latest data center GPU, which is the H100. So we believe the margins is going to expand mainly because the H100 has about 200% more of higher selling price compared to its previous generations, and therefore that itself is already going to drive up the margins. And NVIDIA itself has already guided for a 68 to 69% gross margin for the second quarter, which is like significantly higher than its long-term average of 60%. And then secondly, aside from the data center business, for the consumer side as well, they have also released their RTX 40 series GPUs for your PCs. And these latest generations of the product also have about 20% higher average selling price compared to the last generations. So overall, the products have already increased in prices, and we think this will contribute positively to the margins. However, thirdly is that there's recent news that the US government is contemplating to impose additional curbs on AI chip exports to China. So mainly, especially for NVIDIA, because NVIDIA has disclosed that 20% of the revenue comes from China. And the CFO has come out and said that following the news of the US plan is that they are going to, the company is going to face significant headwind in terms of its ability to continue operating and selling its products to Chinese customers. But again, the CFO has also mentioned that they will not expect the effect to be immediate. And for ourselves, we believe NVIDIA will just create another model that is of lower spec to meet the export requirement, which they did last year when the US government first started imposing the restriction. So yeah, overall, we still maintain our accumulated rating on NVIDIA at a target price of $440. Next slide. Yeah, and then moving on to my last counter, which is AMD, which we have just initiated this week. So the key investment highlight is that we see there's a tailwind for AMD from generative AI. And AMD has been able to gain market share from 4% in 2017 to about 20% in 2022. And this is mainly because of the fact that the products has consistently offered a superior power efficiency. So we think that the current increasing adoption of generative AI is going to boost the demand for servers, and ultimately it will benefit AMD because this means there will be increasing demand for server CPUs as well. And then furthermore is that there are more and more workloads being migrated over to AMD-based systems, which means that this will provide AMD the chance to increase its market share as well. However, in terms of the data center GPU market, AMD is still underrepresented there with only 8% share. But despite this, we think AMD is able to increase its market share there as well, given as we believe that the customers are going to look for second source of supplier so that they don't have to rely as much to the large incumbent player, especially during the periods of shortage, given the current rapid adoption of the generative AI. And then for the second point is also that we see there's a potential for AMD to expand its margin. So the company has been able to increase its margin from 34% in FY17 to a high level of 48% in FY21. And then the company was also able to achieve a 45% gross margin last year, despite the fact they have incurred additional $1.4 billion in amortization because of acquisition, and also because they have faced margin contraction in the client business. So yeah, we think the gross margin for FY23 can expand, mainly because it sells more of its data center and embedded products, which are of higher margins. And then specifically for data centers, they have just released the latest data center CPUs, which have about 50% higher ASP compared to the past generation. So as more and more customers buy these products, this is going to contribute meaningfully. This is going to contribute positively to the gross margin as well. And then for my last point is that same thing as NVIDIA, there's also the growing uncertainty arising from the US-China tension. Although AMD doesn't disclose how much revenue they make from China, about 70% of their total sales are coming from the international market, and we can expect quite a significant portion of that is coming from China. So yeah, if the US government decide to pose an additional curbs for AI chips export, we think this will going to impact AMD as well and its ability to continue to sell its product there. So yeah, overall we have an accumulated rating on AMD with a target price of $135 US. With that, that is my last counter. Now I'll hand over the time to Ambrish to run his. Thank you.
Thank you, Max. So moving on to Microsoft, we have the title Azure Consumption Moderating. So we believe that for Microsoft, there are two main growth drivers. It's a cloud service product, which is Azure, as well as its productivity software, Office 365. And the number of users and the revenue per user is increasing for both of them. So as from the right-hand side chart, we can see that cloud and productivity, it nearly contributes about 70% of its total revenue. So moving on to our first thesis for Microsoft, Azure cloud momentum, it's still continuing and it's the fastest growing segment for Microsoft. So Azure, it has a market share of currently of about 23%, and it has doubled over the last 5 years. Whereas the largest cloud player, Amazon AWS, it has a market share of about 33%. So Azure, it has been gaining market share from the peers, and we believe that it should continue to gain market share mainly because of its integration capability with Office 365, as well as Microsoft claims that it has a pricing power over AWS, and also with the digital transformation trends, the company Azure, it should benefit. And the surge in Azure, it should overall benefit Microsoft mainly because it should improve its profitability as cloud business. They are of high margin business. So for the June ended quarter, Microsoft, it expects Azure growth of about 27% year on year. And this is the fastest growth as compared to its peers, AWS and Google Cloud. However, the growth rates are still moderating over the last few quarters, mainly because of macro pressures as the companies, they pause their IT spending investments. So moving on to the second thesis from Microsoft, that there's continued demand for Office 365 productivity software. So Office 365, it includes its Word, Excel, Teams software, and it has a market share of about 90%. And it has it consistently the demand for Office 365 is high, mainly because of the rising need to manage tasks and workflows. And the demand, it's coming from front-end workers as well as small and medium enterprises. And we believe that the due to the weak demand in PC sales and laptops, it should not impact Office 365, mainly because large part of its demand, it mainly comes from secular corporate spending and not from the individual customers. So, and as a result, for the June ended quarter, Office 365 commercial revenue, it's expected to grow by about 16% year on year. So with respect to the risks for Microsoft, we believe that the Windows OEM revenue, it should be impacted by the weak PC sales, mainly from the consumers. And Windows OEM revenue, it basically, Microsoft generates this revenue from the PC manufacturers like Dell and Lenovo, who install Microsoft software on the Windows software on their operating machines. So, lastly, Microsoft, it has integrated AI into its products like the Bing search engine, then Office 365 and Azure. So we believe that in the near term, it should not benefit from the Bing, mainly because it faces competition from Google's Bard, as it has about a 90% market share in the overall search queries. However, Azure and Office 365 AI integration, it should help Microsoft to drive its top line growth. And lastly, we have overall a neutral recommendation for Microsoft, mainly because of its recent jump in its share price. Next slide, please. So moving on to Airbnb, we believe that the travel demand is still healthy. So basically, Airbnb, it's an online marketplace for homestays and unique experiences. So if you take a look at the right-hand side chart, in FY22, company, it reported a bookings volume of 394 million. And this has already surpassed its pre-pandemic levels. And we expect the volumes to grow by about on a CAGR of about 15% over the next 2 years. And this is mainly because the growth should come from the urban and cross-border travel as the COVID restrictions they have eased. And also the stays of longer than 28 days, they have remained resilient, mainly because of flexibility due to work. And the stays of over 28%, 28 days, they contribute about 18% of the overall booking volumes annually. And secondly, Airbnb, it's getting profitable. Last year, it reported a net profit of maiden net profit of about $1.9 billion. And it should continue to increase this year and going forward, mainly because of a high operating leverage and top line surge from the boost in travel demand. So moving on to our second thesis for Airbnb is that the active listings on its platform, it has been consistently increasing. At the end of December 2022, there were about 7 million active listings, and by the end of March, I think the company reported that they grew by about 18% to 7.6 million listings. So the surge in active listings, this is mainly because Airbnb, it has continuously improved its platform by adding new features and supporting hosts like Airbnb Setup and Ask a Super Host. It has also provided insurance facilities to the hosts, and also mainly because hosts, they want to earn an additional income, and that's why they are listing their properties and thereby generating the demand for travelers. So moving on to the negatives for Airbnb, we believe that the rental rates or the average daily rates, they are expected to be under pressure in the next half of this year, mainly because of the business mix shift towards the urban and Asia Pacific regions. And this is mainly because the urban regions, they have smaller room sizes and lesser facilities as compared to the non-urban listings. And additionally, Airbnb, it should face headwinds from like high inflation and rising interest rate, mainly because it's a consumer spending, and it might get hurt when the travelers, they reduce their travel budgets. So overall, we have a buy recommendation for Airbnb, and we have a target price of $1.43. And we believe that with the shift to alternative accommodations, Airbnb should benefit, and mainly because it's more family and group friendly, and it provides additional amenities as compared to the hotels. Next slide, please. So moving on to the third stock pick for me, Salesforce. We have a title of continued margin expansion. So Salesforce, it's basically a cloud-based software company, and mainly because of its software as a service business model, it generates about 90% of its revenue via subscriptions. And the two main core products of Salesforce are its Sales Cloud and Service Cloud, and they basically help businesses to automate and manage their sales operations or to provide enhanced customer service. So moving on to our thesis, there is continued demand for the Customer 360 platform from Salesforce. So this is mainly because the Customer 360 platform, it basically it provides a full suite of its overall products. It unites everything into a 360 platform, and in such a way that it integrates marketing, commerce, service segments, IT segments, and the business. Then they get a 360-degree view of all the customer information. For example, if a service agent, it will if it's servicing a customer, then it would automatically get access to the customer's previous sales information, and based on that, it could efficiently resolve that query. So there has been continued demand for its product. Secondly, it's Salesforce, it's focusing on cost-cutting efforts. So for the FY24, it expects adjusted operating margin of about 28%. As compared to 23% the previous year. And this is mainly because it's focusing on cost-cutting initiatives. Like recently, earlier this year, it had laid off about 10% of its workforce, and also through real estate consolidation. So meanwhile, just as a note, adjusted operating margin, it basically means it excludes non-cash expenses like stock-based compensation, and also amortization of intangibles and one-offs like restructuring expenses. So moving on to the third point, Salesforce, it has already integrated generative AI into its various product portfolios through Einstein GPT AI tool. So this tool, like for example, Sales Cloud, for Sales Cloud, a salesperson, what AI will do is it will help them to generate compose sales emails or schedule meetings, or also they can prepare it for the next interaction, what other things that a salesperson should be prepared. Whereas for the Service Cloud, it can auto-generate personalized texts wherein the agent can reply via chat to the customers. And also, like for example, it has also integrated AI into its Slack product, like wherein it can just make a summary of all the conversations that have been made. So overall, with this AI interaction, recently earlier this week, Salesforce, it has announced a price hike of about 9% across its product range. And this was done mainly because the last price hike was done around 7 years back, and with continuous product improvements and AI integrations, the company said that it would be increasing its prices by about 9% by the end of August. So, and this would happen for new customers as well as for the renewals. So we believe that it should be a tailwind for the top line growth. It should give a boost as the price hike, as the customers, they renew their products. So overall, we have accumulate recommendation for Salesforce, and we have a target price of 226. Mainly, it's down as compared to previous last close, mainly because it has jumped up on this price hike news. So that's all for me. I would now like to pass on to Zain for technical analysis.
Thanks, Ambrish. Now I'll go through the technical analysis. So I'll be giving the outlook for NASDAQ and S&P for this quarter. So for NASDAQ, please. So looking at the chart wise, we're definitely trading at an uptrend channel. So currently we are around close to 14,000 points. and also the 61.8% Fibonacci retracement level when take the swing high of the all-time highs and lows in October of last year. At this current level, I would say we are near the or at the uptrend channel resistance currently. So for this quarter, there could be some sort of a pullback if we do stay within the uptrend channel itself. The current resistance wise could be at around this level from about 14,000 to about 14,500, which was the swing highs in January and March of last year. Then support wise could be looking at around 13,000 for some good support, which was the swing high in August of last year, as well as the possible channel support now. Yeah, so for this quarter, it's likely to be between 12,800 to about 14,300, this range. Next slide. Of the S&P 500, we are also definitely trading an uptrend channel. In terms of the chart wise, we could have a little bit more room as compared to NASDAQ. In terms of resistance, the near term one would be around 4,500 to about 4,600, with 4,600 being the swing highs in January and March of last year. So in terms of chart wise, I would say a limited upside in terms of the uptrend channel. If we do stay within there, we could see a little bit of a pullback this coming quarter to maybe if you do tap on to the resistance and come down a bit. In terms of support wise, it could be around 4,002 to about 4,003 for some good support for now. Yeah, so for this quarter, we could be trading between 4,200 to about 4,500. So that's all from me now. I'll pass back in time to Jonathan to talk about our US stocks coverage. Thank you.
Thanks, Zane. Yeah, so it's just a slide of the companies that we cover, their tickers, their ratings that we gave them, target price, and their last close price. So in conclusion, we do think that services inflation is going to remain sticky, especially with unemployment remaining relatively low and we just continue to grow. We do think that most of the rate hikes have already been priced into the market. So unless the Fed does something drastic, either they increase rates even more or they cut rates earlier than expected, we don't think that anything out of the ordinary would really move the markets that much. We do expect growth stocks and tech stocks to cool down a little bit, especially after the significant run that they've had in the first half of this year. Although we still do have some of our top picks that namely would be Alphabet, Microsoft, and Nvidia. Google, they're still the dominant player in digital advertising and search. So they've got quite a large moat around them. Nvidia, obviously, they've been helped by the push for generative AI, and so we think that demand in AI will only benefit them in the long term. And for Microsoft, because they have both productivity as well as cloud and cybersecurity services that we think, in the long run, obviously they're going to be performing a lot better than a lot of other companies. And we do think that these companies, even though they are growth companies, they've got a strong balance sheet, strong earnings, and I guess if you compare them to a lot of other companies, it'll be a little bit more recession-proof in that sense. So that's all for us for today. In case you want to contact us, just scan the QR code, or you can always reach us by email, or you can call us. Do also follow us on our community groups on our Poems Mobile 3 app. We're always on there posting stuff. If you have any questions, feel free to post it up there. We'll try to get to your answers as soon as we can. So with that, I think we'll head over to the Q&A. Maybe each analyst will take 3, and then we'll hand it off, and then we'll just keep going until about 9 o'clock. Also, if you have any TA questions, feel free to ask Zane. Just put it in the Q&A as well. So we have the first question here from Johnson. I guess I'll take the first 2 questions over here, since they're quite similar. The rise in the S&P today is mainly due to the tech sector, which is overvalued. Why are investors not looking at consumer staples or healthcare sectors, which are relatively cheap? And the next one is, when do you think the Nasdaq run up will start to slow down or turn around? So for the first question, you're right. Most of the gains have come from the tech sector, which is pretty overvalued, we think. But instead of actually consumer staples or healthcare, we think that utilities could actually be a good play. They are essentially interest rate sensitive as well. So, if and when interest rates start to come down, they would stand to benefit because, firstly, everyone needs your utilities. Secondly, a lot of their value comes from dividends. So if their dividend payouts, their dividend yields start to be a little bit more attractive compared to your 2-year or your 10-year, then it definitely would drive some value there. Another two cyclicals that you could look at right now that we think are fair value would be materials and industrials. We think that these industries, in terms of your forward PE, are hovering around their long-term averages. So even though they may not be as good as you want them to be when you compare them against the rest of the other sectors, which are closer to their one standard deviation away from their averages and stuff like that, those would probably provide a little bit more value to look at. So answering the second question, when do you think the Nasdaq run-up will start to slow or turn around? I think it's very difficult to predict, when this will happen, especially with such momentum going for the Nasdaq. Do you think that it'll probably take some adverse news, maybe some adverse news from the job sector, or because in theory, with high interest rates, valuations for a lot of these companies should be a lot lower. But obviously this hasn't been the case, and so it definitely will take something like some sort of adverse news or maybe a recession for something to at least slow down a little bit. I'll take that last question before handing it off to my other colleagues. There's a question here from Jotham. On Alphabet, machine learning is already used in their advertisements. AI-driven efficiency will also be used among other tech companies to increase productivity besides Alphabet. So how will AI really drive margin recovery for Alphabet? Okay, so there are two things, and they're mainly on the advertising side. The cloud side, regardless, will drive margin growth. But for advertising, there are two things. The first thing is that with search advertising, the way advertisements work is that it's like a marketplace. So it's really dependent on supply and demand. So if you can, for example, if Alphabet, as a company, can improve the performance of the search ads that are being placed, and they use, and they constantly improve this by using AI technology, then by right, more people want to place their ads there, which will drive the price up. And Alphabet will collect the revenue from that, right? But the cost for Alphabet remains the same whether the prices are high or the prices are low. On the second front, which is like your targeted advertising, again with AI, if you can reach, if you can increase the performance of your targeted ads, you can reach better viewers, more viewers, with a higher conversion rate and a higher ROI. Naturally, you'll be able to charge your clients a little bit more, because targeted ads are all run on contract, right? So it's a agreement between an advertiser and Alphabet. So in some ways, these are the ways that for advertising, AI can really help to drive margin growth for this. In terms of a company operating, I think maybe less AI but more automation. So if you just incorporate more automation into your daily ops, you require less manpower, less overheads, less officers, and that will just help your fixed costs come down a little bit. Yeah, so I hope that kind of helped to answer some of the questions. I'll hand it over to the rest of my colleagues to take the other questions. Thank you.
I guess I'll go next. Yeah, so thanks, Jonathan. So there's some questions for me. Firstly, is that when do you think Intel will start to benefit, given my sharing that semicon seems to turn around? So yeah, for Intel, we don't cover Intel, but from what we know is that Intel during their last earnings call back in end of April, they indicated that their data center business still has not bottomed yet. So I think that's quite a worrying sign. So, but I guess if we take a look at the market expectations and then what we see during the past 12 months sales that I showed just now, we think Intel should be able to provide some positive news. I think at most it's about 1 quarter later than AMD for its closer competitors. So I guess this quarter they may say that the markets have bottomed, and maybe let's say in the next 2 quarters, which is in the fourth quarter, I think there's a chance that they might say that they are expecting a gradual recovery then. Yeah, that's for Intel. And then I think I have two more. Yeah, so there's a question, another one is, has the semiconductor hit the bottom or near bottom? Yeah, I think I've answered this just now during the presentation. The semiconductor seems to have already reached its bottom, and the market is expecting a gradual recovery starting in the second half of this year. Then I guess I have one more here. Let me take a look. Yeah, this is one. Indian defense tech giant Rostec just bans all staff within the state corp from using iPhones, affecting some 600,000 people. Any effect on iPhone, and is Apple closing their India plant and shifting back to China? So yeah, I believe Rostec is from Russia. Is from Russia. So yeah, they do ban the usage of iPhone, but I think it won't cause any significant impact on the iPhone sales because generally it's just affecting one company. So it's not like the entire market of the entire population decides not to use iPhone. And given the fact that Apple is still very bullish on India because of the rising middle income demographics, we think it's very unlikely that they're going to pull the plug from that market. And then on the second part is that is Apple closing their plant in India and shifting back to China? No, we don't think so because I believe that Foxconn has already signed the deal that they are going to continue building out their plant. It's just that the recent news is for Foxconn's plan to build a fabrication plant for semiconductor, which is not really related to Apple because Apple's chips come from TSMC instead of Foxconn. So Foxconn is essentially just assembling the various parts of the iPhone. So I don't think that will really affect the Apple there. So, and Apple has already in fact pushing their supply chain partners to invest more in diversifying their supply chain to China, to India for that. So yeah, the answer to that is I don't think that is the case. So yeah, I hope that answers your question, and I'll hand over to the rest of my colleagues.
Thanks, Max. Amrish, I'll take this one question first before I hand it over to you. Just be a very quick one. Okay, so the question being, has Bank of America already priced in the negative news on them recently, such as a $250 million fine? And what's my view for the next 6 months? Yeah, so this $250 million fine, if you look at it in the bigger perspective, it's really not it might seem it is a lot of money, yes, but if you look at how much they have earned, their net profit for the first quarter, I think it's around 3% or even less than that. So that's 3% of the net profit for the first quarter. So it's I mean, it's their fault that they did something, which is why there's this fine. So I don't think it will really move the needle, at least for the share price. And my view for the next 6 months, just a quick recap. I would just reiterate my points, being that the net interest margin should remain high and will continue to remain high, at least for the next quarter, and will sort of taper off at least the last quarter of the year. And this will continue to improve their net interest income. However, their non-interest income will most likely remain stagnant or even decline due to the dip in their investment banking arm. And there's also a chance that the provisions might increase as their consumers start to feel the pinch from the high interest rates, as well as declining loans growth for the banks. Yeah, so I hope that answers your question. Thanks.
So there were a couple of questions for me, on Microsoft, which cleared hurdles to its planned purchase of Activision. Will that in any way have significant impact on Microsoft revenues? So basically, we still have to wait till the time the merger is closed, mainly because it still faces the UK is still pursuing it to block the deal. And so with terms of its impact on revenues, I believe that Activision, it generates about 10 billion US dollars annually. So it should be a boost of about 3 to 4% to Microsoft's revenue in the calendar in FY24. And this is mainly because it will get access to the gaming market as well as the Call of Duty gaming from the Activision Blizzard. So moving on to the next question, PayPal seemed to have bottomed out. Any view on their prospects? So PayPal, it's basically a fintech company, and it has a presence of about 200 countries. So what PayPal does, it serves both customers as well as merchants. It has a type of about 200 merchants who can use PayPal to transfer money, peer-to-peer transfer money, as well as it has a base of about 35 million merchants, which the customers they can use to make them payments for any purchase of goods or services. So we believe that the PayPal, it should benefit mainly from the shift to digital payments, as well as its two-sided network, as it handles both customer side as well as merchant side. And also it has a few strategic partnerships with Amazon, like its Venmo service has been added as a payment service on Amazon. So it's likely to be impacted. It should increase the transaction payments volume for PayPal overall. So yeah, overall for PayPal, we have a buy recommendation with a target price of $103. So there was one question with respect to what's the difference between accumulate and buy ratings. So for stock returns of more than 20%, we have a buy recommendation, whereas stock return of 5 to 20%, we have a recommendation of accumulate. So there was one more question with respect to C3 AI. Any thoughts on C3 AI in the next 6 months? So I'm not too familiar with this company, but with respect to its significant surge of about 200% year to date, and considering that its revenue is expected to grow by about 16% this year, and it's still not generating any profits, I'm not too sure how much this rally could be sustainable. That's all for me. I would now like to pass on to the rest of my colleagues.
Thanks, Ambrish. I guess I'll take some of the other questions. There's a question here, is PLTR, Palantir, still a good buy at the current price? So we don't actually cover Palantir, but I had a brief look at it, just based on like your ratios, right? I think it's trading at like almost 18 times price to sales, which is extremely high. Most companies, I mean, your FANG-M, the average, I think, for FANG-M companies is like 6 times. And so I think probably some fair value for Palantir will probably be somewhere closer to like 11 or 12 times price to sales, which will put it somewhere, I guess, in the $12 range. I did hear some good news about Palantir, but it probably has run up a little bit too much just based off the AI hype plus its profitability and stuff like that. So short answer, no, it's not a good buy. It also depends on your horizon. Right? If you're gonna be holding Palantir for the next 10 years, then yeah, it probably won't be a good buy. But if you're looking at I guess a shorter time frame, like 1 year or so, then probably not. There's another question here on Meta. With the introductions of Thread, will it have to drive margin recovery? So yes, actually, so Threads, it's interesting how it took them so long to do something like Threads, because the cost to them is very minimal, right? To set up a new platform that they already have, plus they've got a few billion users. So even if you just take a percentage of the number of users they have and port them over to Threads, you just have this really large opportunity for more advertising space, which essentially is probably how they're gonna monetize it. Obviously, it's still early days, but Definitely it should help to drive significant margin recovery if they get enough users on it. And so far, I've had a lot of friends, both here as well as in the US, that have already started using Threads. So I do think that the take-up rate, just from my small, I guess, sample, is pretty good. So it's definitely a positive for Meta. And that's probably why stock price has gone up, continue to climb as well. There's another question here on EVs. How about other EV companies like NIO, XPeng, and Li Auto? Are you bullish on them as well? So we don't cover all of them, and but short answer is not really. I think BYD still dominates the Chinese EV industry. At the same time, I believe NIO, XPeng, and Li are all not profitable. So they don't have the scale that BYD or Tesla has. From a production front, it's difficult to become profitable if you don't have the scale of production. And we think that it's difficult to bet on some of these smaller companies when your leader like BYD in the Chinese market is so far ahead of everyone else. It also is going to be difficult for some of these companies to export out of China, because we're not sure if the demand from Western countries will be as high as they would expect. Yeah, especially if you have an option like Tesla that continues to drive price low and make it a little bit more affordable. Let me take a couple more questions. There's one here: is the QQQ and VOO the best ETF for the tech sector? So the QQQ, is actually a proxy for the Nasdaq 100 index, I believe. The VOO is actually for the S&P 500, so it wouldn't be the best ETF for the tech sector. So it'd just be the QQQ. Yeah, so you've got in addition to the QQQ, you also have like the TQQQ, which is I believe is your 3 times leverage QQQ, and then you've got your SQQQ, which is your short QQ, but they're all in the QQQ family. Yep. Another question here, I guess I'll let's take a couple more. Then maybe you can hand it over to Max and Ambrish for another couple of questions before we wrap up. There's a question here: what are the effects of Harmony OS on Google Android? So Harmony OS is OS developed by Huawei, I believe. It was used in their Honor phone, and then now using their Huawei flagship phones, or actually all Huawei phones. We don't think that be significant impact to Google Android, because Android is still the main, the dominant player in terms of mobile OS. And we do think that if anything, it will be quite localized to the Chinese market, especially with a lot of concerns over Chinese software from US manufacturers and US companies. I think the pickup will be slow, if anything, and definitely they will definitely take market share away from Android, which is Alphabet, but don't think it will really significantly dent Android's mode and leading position. Yeah. So hope that helped to answer your question. I hand it over to back to Ambrish for a couple of cybersecurity and Visa and Mastercard questions. Ambrish?
John, I would like to take up the question with respect to Visa. Is the Visa stock, is it still worth investing or not? So Visa, it's basically it should benefit. It's the largest card-based payments company in the US, and it competes with Mastercard. So Visa, it should benefit from the shift to the cashless payments. This is one of the investment thesis. Could be one of the investment thesis, as well as its revenue. It's growing double digit, and it's expected to grow by about 11% this year, FY23. And Visa, it should also benefit from the surge in travel, as mainly the travelers, they spend via the credit cards or over the online portals, or whenever they are traveling. So Visa, it should be a good investment, positive overall. Yeah. That's all for me. I would like to pass on to Max.
Yeah, thanks, Ambrish. We have this one question. Why is Intel lagging AMD, and what is the outlook for Intel given the reshoring strategy? So yeah, the reason Intel lags AMD is probably because of the fact that its product is less power efficient. So buyers customers who choose AMD buy the product because they are more power efficient while giving similar performance. But although the latest CPUs from Intel has just a slightly bit more power compared to those of AMD's. And then with that, putting that aside, there's also the fact that AMD's products are generally cheaper than Intel. So I guess when customers weigh the performance to the cost benefit, I guess most of them still prefer AMD if they were to invest in a new system. So, but with that regards, Intel still holds the dominant share in the CPU market, and this is mainly because of that. It has been around it has been used for quite a while in the data center space. So the operators and the developers are already comfortable with it. But as we can see, AMD is continuing to gain share because more and more customers are just think that the price advantage of AMD is better. And then what is the outlook in terms of the reshoring strategy? So yeah, I guess Intel is betting big on its new fabrication, building its new fabrication. But I think it's not going to be all rosy because ultimately they're going to compete with companies like TSMC, who has the most advanced manufacturing technology for semiconductor. And so if let's say they can compete, I guess they will already be ahead of Intel for that matter in terms of the technology wise. So yeah, I think it will not be as as a big of a bounce as what Intel has claimed. So yeah, I think that's what my thought this is what my thought on it. Then yeah, I think I'll hand over the time back to Jonathan. With that, thank you.
Well, thanks, Max. Actually, we'll pass it to Ambrish there's a question on Adobe. Like that.
Yeah, so there was one question with respect to Adobe. It has been in use for the last few months. May I know what is the reason for rating downgrade? So particularly for Adobe, we have a reduced recommendation, and this is mainly because of the recent run-up in its share price. Like it has run up by almost 30 billions over the last one market cap. It run up by about 30 billion over the last 1 month or so. And if we compare that with respect to the possible annual incremental profit opportunity, even if we assume that it's a AI tool, which is Firefly, even we assume that it could double it in revenue. So even if on that assumption, the incremental profit opportunity that we get is of about just $3 billion. And we believe that the Adobe stock, it has run up too quickly in the short term, and not sure if that could be sustainable. However, yes, it's AI tool. It's still promising. It could generate images from text descriptions and all, but it still faces competition from OpenAI's DALL-E as well as Mid-Journey. So yeah, so overall we have a reduced recommendation for Adobe. Pass on to John.
Thanks, Ambrish. Okay, so I'll take maybe the last 4 questions before we end up, since it's already 9:03. First question here is, any views on cybersecurity companies like Zscaler, CrowdStrike, NetEase, and Okta? Yeah, so we don't cover any of these companies, but in terms of cybersecurity, you would think that long run, there'd be an increasing need for cybersecurity, especially as more and more companies get digitalized, everything's cloud, everything is a little bit more easy access. So definitely, yeah, as a sector, you will be bullish on the cybersecurity sector. Yeah, unfortunately, I can't give you much more than that. Hope that helps. This other question here is, can you comment on US REITs? Have they bottomed? Again, we don't cover US REITs, but from what is happening right now, I think still looks a little bit ominous. I mean, hear about a lot of malls closing, like largest mall in Bay Area, I think just closed, Westfield, something like that. Office occupancy rates also are not really coming back. So, there's still a little bit of chalkiness in terms of US REITs. At the same time, if the Fed is going to continue raising rates and keep it there for a little bit, then because REITs are very interest rate sensitive sectors, right? And there's not really much positive news in that sense. Yeah. I hope that helps. Sorry, but we don't really cover US REITs. So last two questions here. Can you comment on Tesla and target price? Yeah, we don't actually cover Tesla. So we don't have a target price on Tesla, unfortunately. What I can say is that they're growing really fast, and they basically have a vertically integrated supply chain. They're gonna start refining their own lithium soon. They've got really good battery technology, and all signs point to good news for Tesla. Deliveries for this second quarter really came in far above expectations. And they're on track to hit, I believe, almost 2 million deliveries for this year. So that's quite a significant increase. Yeah, unfortunately, not much more I can give in terms of like a recommendation target price for Tesla. Last question before we wrap up here. How do you evaluate intrinsic values of index ETFs, like the SPY? So I guess, like the index, you will probably have to actually evaluate the index, because the index will give you, your EPS and stuff like that. I'm not sure if ETF has I'm not 100% sure about this, but you most likely will have to go to the index and then derive some sort of value from the actual index itself, and then kind of transpose it into what price the SPY is at. Yeah. Hopefully, I hope that kind of helps. Fortunately, not really too sure on that. But yeah. So I think with that, we'll kind of wrap up our time here. Thanks for joining us all. It's getting a little bit late at night. The US market is going to open pretty soon. I'll hand it back to Roshan to really wrap us off. Thanks everyone for joining us.
Great. Thanks, John. Thanks again to our speakers for the presentation and interactive Q&A. We have now come to the end of the webinar, and we would like to thank you all for joining. For tomorrow, we are excited to present another brand new market, Japan market, which Tomoyuki Misumi, research analyst from Philips Securities Japan, will share his insights at 1 p.m. to 2 p.m. Remember to mark your calendars. It's tomorrow from 1 p.m. to 2 p.m. For the session just now, we will be uploading the recording on Phillip Capital's Facebook page and YouTube channel. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Do take your time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code or copy the survey link posted on the chat tab. You may also join our investing communities to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us, and we hope to see you tomorrow. Tomorrow, we will have Tomoyuki Misumi to share his insights on the recent change in Governor of the Bank of Japan to Mr. Ueda Kazuo, a potential policy change and its effect on the Japanese equity market. Additionally, he'll bring to light large cap stocks anticipated to show favorable performance in light of these changes. Stay tuned, take care, and have a nice evening. Thank you.
Thanks, everyone. Have a good night.